Hello, hi. Okay, just now I actually talk about my earlier episode. I was actually mentioning about the geopolitical tension that's happening, the Russian-Ukraine war that's actually ongoing right now, as well as the CPI data, and that will probably kind of like uh, maybe guide us to think what the Fed would be doing in August. They're taking a break in September onwards, and also the political climate in US, which is the midterm election coming in. Yeah, so these 4 5 things I think was mentioned in my previous episodes. Um, Now I wanted to kind of like talk to you about the market value, the company's valuations, and how companies actually fare in quarter 2. I would say Q2 2022 was, between April to June was probably one of the worst months. I'm not sure whether you can actually compare that with COVID period, right? That March, the April 2020 to June 2020 period, where you see shutdowns and all that, where travel stocks or companies were probably having near to zero revenues and all that. Q2 for 2022 looks relatively kind of very fearful as well. You got the gas issue, economic war between Russia and Europe, and then you got the actual war between Russia and Ukraine, and then you got that fear of winters coming, and you have to chop wood and burn wood and keep wood in your house, or they might need to do rationing and all that. And then you see inflation keep going up, the supply chain crisis and all that nonsense, right? So and the fear that it will continue to go up and all that. So as I mentioned earlier, US inflation eases slightly, and back to this market talks about Q2 companies earnings being slashed, or rock bottom, and probably will create a crash in the market, and Fed raising interest rates in a slowing economy. All those it's actually making things doubly worse. But then if you look at the inflation actually has improved, and then if you look at the Q2 results of some companies, for example Apple, they've done really well. In fact, they are still going at low double digit growth. Meta may still have high single digit growth. And if you look at Disney today, they are having um, 23 to 29 revenue growth, from Q1. So it's actually quite amazing. Of course, you get some companies as well. It's a mixed bag. Some companies like Snap, they give warning guidance that they will slow down. Walmart, say that they have huge inventory. People are more prudent in their spending and not spending as much, not going to the grocery and spend so much, and all those things. So yeah, some companies are being slashed as well. And but overall, if you look at Disney, you look at the oil and gas company in US, fertilizer companies, they are actually very resilient. Apple, for example, their service um, income, not selling of iPads or the hardware, but talking about Apple Pay, which is a fintech. By the way, Apple Pay is coming into Malaysia, and you will, and you have the Apple apps, where they're taking a percentage from everybody, from every downloads, or any games. So those are going up at double digits growth. So there are definitely slowdown in spending, but there were too much stimulus in the market during the 2020 and 2021 period. Yeah, consumer spending behavior and all that may pull back a bit, but debt service ratio today, banks, consumer, individual, there's not many bankruptcy cases and still pretty much holding strong. And I think if you look at Q3 as well, of course, especially in tech industry, there were a lot of um, job cuts, from Tesla to Coinbase. to Facebook, or even freezing of hiring. Um, like Google was saying that there were just too many staff doing very few jobs. But then at the same time, there are just jobs opening in other places, like for example, in mining, in the CHIPS Act spurring a lot of jobs in the construction sector and all that, and eventual market employment in sectors like manufacturing. So that's why you see the jobs market actually went up a lot. So um, there's a pullback in activity, but if you look at a full blown pullback, right, it looks like US are quite insulated, even though even though there are companies where have global reach, like PayPal and Meta, or Tesla and all that, yeah, you will see global slowdown would affect their sales as well, but they are still actually growing. That's the thing. Very strange. So, what stocks to pick? I just wanted to share with you this very interesting article.
This close
Wait,
is
just
having a third risk factor, and as you can see, significant differentiation compared to those scary points.
okay.
I want to
Listen to
ask
this.
you about just sort of continuing this market conversation part about the big tech stocks and FANG and all that. You're out in California. You have some exposure to that community as well. What is your thinking on the prospects for those companies? We're in the midst of earnings seasons for them as well.
We are, and I think on the whole, the earning messages are things are not as bad as people were afraid of, and that's the good news. But what you're seeing is significant differentiation compared to Snap to an Alphabet. So we're seeing, and then we're seeing dispersion happen. If you like, think in terms of a distribution. Big tech is going to do fine. And then venture opportunities remain exciting. It is the middle of the distribution where you don't have scale, where things are getting more difficult. And that's why Snap is in that direction. So this is a very barbell situation, and it's going to remain so for the next few months.
So in other words, the venture, you are excited by the prospect of
Yeah, so I will put this link below for you to watch the entire video in its entirety. Basically, he did mention that there would be significant differentiation. So when you pick stocks or company, those in the middle, probably the old school brick and mortar business where they can't scale and they are facing headwinds and high interest rates, interest costs, or high input costs, or remain high input costs, and they don't have rising pricing power to price up. Those would be in a difficult situation or in Q3 and Q4. Whereas the FANG has constitute like 40% of the Nasdaq, and some very interesting tech which has still have growth of double digits, will probably still be safe. I will be talking about software companies in my next episode, and also this company called Waiter in the future episodes as well. So those middle in the distribution, as Mohamed El-Erien mentioned. So take note. So of course, the Fed also is coming in to print more money with the Inflation Reduction Acts, and also the Inflation Act as well. The CHIPS Act as well. Of course, I will elaborate on the macro part of what is the act, what does each of the act entails. So but basically, just reduction of some pharmaceutical prices, share buyback taxes, because they need to, every stimulus that they do, they need to create more taxes to show how they can actually get the money to do it. And the CHIPS Act, sorry, the anti-inflation, the act, right? Sorry, what's the name? Inflation Reduction Act, right? It actually provides some stimulus for certain companies like Tesla and all that, right? But you need quite a lot of components made in US. So there's a lot of like 800 billion being given out and all that, but it's very hard to claim those money. I'll be talking about that later on in detail about these two particular acts. but they're actually, of course, putting money into the market, printing more money, and I think is also another good sign for the market. So yeah, hope you like this channel, and thank you very much, and hope to see you soon.